Welcome to vTalkInsight, Risk Sentiment Daily for December 19th, 2025. Markets are coming off a notable equity rebound powered by softer inflation data and a powerful AI earnings story, but the macro and policy backdrop remains finely balanced. Let us unpack what that mix means for risk appetite right now. Risk sentiment today looks cautiously risk-on, with investors stepping back into equities after several days of pressure on AI and growth names earlier in the week. The S&P 500 has bounced roughly 0.75%, and the Nasdaq is up closer to 2%, helped by disinflation-friendly inflation data and a strong semiconductor earnings print. Volatility remains in the high teens, so this is not a euphoric melt-up, but it is a clear improvement from yesterday's more defensive tone when AI-heavy benchmarks were underperforming and demand for hedges was rising. Cross-asset signals broadly support this cautiously positive stance. High-yield credit is still trading near its highs despite recent equity volatility, suggesting limited concern about imminent systemic stress. Market breadth has improved as more stocks trade above key moving averages and a wider list of names prints new highs, pointing to healthier participation beyond the mega-cap complex. At the same time, retail trading activity and ETF turnover remain elevated even with subdued volatility, underlining a persistent bid for risk. Underneath that, however, there are plenty of reasons for caution. Inflation data are being questioned, labor indicators are softening, and long-end yields remain sticky, all of which cap how far risk sentiment can run. Central banks are edging toward or are already in easing mode, but communication missteps, as seen with the Bank of England's recent cut that drove gilt yields higher, show just how sensitive markets are to any hint of a slower or shallower easing cycle. Putting this together, the backdrop still looks late cycle and data-dependent rather than outright bullish. Softer inflation prints and AI-driven earnings support are pulling investors into risk assets, while concerns about stickier inflation, stretched valuations, and emerging credit risks keep them from chasing aggressively. That tension sets the stage for a market where good news on prices or growth could extend the rally, but any upside surprise in inflation, a wobble in labor data, or a credit accident could quickly push sentiment back toward risk-off. Disinflation and central bank easing hopes are a key bullish driver today. The latest U.S. consumer price report showed headline inflation slowing to around 2.7% year-on-year and core to roughly 2.6%, the softest core print since 2021 and well below expectations. That has reinforced a narrative that the Federal Reserve is at or near the end of its tightening cycle and may deliver at least a couple of cuts over the coming year, with some investors highlighting how this environment makes income-generating assets increasingly attractive in diversified portfolios. The easier policy story is not just about the federal. In the UK, the Bank of England has begun cutting, with markets previously assigning near certainty to that first move on the back of weaker CPI and a softer labor market. Across the channel, the European Central Bank is widely expected to hold for now, but the balance of risk is viewed as skewed toward cuts over hikes, as inflation is projected to undershoot target into the second half of the decade. Together with Germany's planned increase in debt issuance for infrastructure and defense, this adds to a perception of a more supportive policy mix for growth and risk assets in Europe. Even so, the market is not blindly embracing an aggressive easing path. Fed funds futures and swaps have only nudged cut expectations higher after the latest CPI, with June odds improving but no wholesale repricing of the trajectory. That restraint reflects clear skepticism about the data. Economists point to survey timing, seasonal quirks, and government shutdown disruptions as reasons the recent inflation prints may be artificially weak, while the Bureau of Labor Statistics carry-forward methodology could be imparting a downward bias through 2026. For markets, this mix of genuine disinflation progress and skepticism creates a powerful but fragile support. Equities, credit, and even crypto have all responded positively to the latest downside surprise in prices, but investors know that any reversal in inflation momentum could quickly force a reassessment of rate cut timelines. The key takeaway is that easing hopes are underpinning today's cautiously risk-on tone, yet they are conditional on follow-through in the data. Upcoming inflation and wage releases will therefore carry outsized weight in determining whether this driver remains a tailwind or flips back into a headwind. AI-led capex, earnings and growth form the second major bullish pillar. Micron's latest results have become a focal point, with revenue surging more than 50% year-on-year and next quarter profit guidance running over 80% above analyst expectations. Management highlighted the largest supply-demand disconnect in memory chips in a quarter century, driven by intense demand for high-bandwidth products tied to artificial intelligence workloads, leaving order books effectively sold out through 2026. Micron is not an isolated story. Data center construction is booming, from Asia to the US, as hyperscalers and cloud providers race to build AI-ready infrastructure. A recent acquisition in the data center space has reportedly grown 14-fold in just 4 years, underscoring the scale of this build-out. Utilities and power market players are also seeing benefits. Rising electricity prices near major data center clusters and higher capacity auction prices in key U.S. regions reflect surging demand, while bipartisan permitting reform in Washington aims to accelerate grid and data center investments. Macro strategists increasingly view this AI capex wave as an upside risk to U.S. growth into 2026, with business investment and confidence becoming key swing variables for the cycle. That supports a constructive view on earnings, especially for semiconductor and infrastructure beneficiaries, and helps explain why AI-linked equities continue to attract flows even after sharp year-to-date gains. There are, however, clear caveats. Power costs are rising for households and industry, political pushback against new data centers is building, and some large tech firms are seeing cash flows squeezed and leverage rise as they fund this investment race. If monetization lags, questions around elevated AI valuations could intensify. For now, though, the earnings reality in semiconductors and infrastructure is validating the AI growth story, keeping this driver firmly on the bullish side of the ledger. Earnings resilience and vibrant deal activity are another source of support for risk appetite. Consensus now projects mid-teens earnings growth for U.S. companies next year, with estimates for 2026 and 2027 being revised higher, helped by lower oil prices and a softer dollar that particularly favor firms with significant overseas revenue. At the micro level, consumer-facing companies are offering evidence of underlying demand resilience. Toy sales are up solidly year-to-date despite higher prices, while casual dining chains that have held price hikes below grocery inflation are winning traffic from both fast casual and quick-service peers. Company-specific stories reinforce that picture. Restaurant operators like Darden have delivered stronger same-store sales even as they manage beef cost pressures, and Nike's renewed focus on wholesale channels has produced better-than-expected growth in North American distribution. These examples, alongside standout beats in areas like AI semiconductors, help investors look through weaker spots such as homebuilders facing pricing pressure and incentive-heavy demand, suggesting that aggregate earnings power is holding up better than the macro headlines might imply. On top of earnings, the forward pipeline for capital markets activity looks busy. Banks and advisors point to a substantial backlog of IPO-ready companies, particularly in technology and AI, with expectations for a wave of listings over the next 1 to 2 years, including potential offerings from mega-cap private names. Large-scale mergers and acquisitions are also expected to accelerate into 2026 as corporates and financials take advantage of tight credit spreads and supportive funding markets. While valuation gaps for 2021 and 2022 private equity vintages may slow some sponsor exits, the overall picture of rising deal and listing activity is typically associated with a more constructive risk environment. On the bearish side, sticky, underreported inflation and tariff pressures remain a central concern. Several analysts argue that recent U.S. inflation prints are flattered by survey timing quirks, unadjusted seasonal factors, and data gaps linked to the October government shutdown. Because the statistics agency has been carrying forward prior month values to fill missing data, the official series may have a downward bias that lasts into 2026, suggesting inflation is not falling as quickly as the headlines imply and may rebound in coming releases. Beyond the measurement noise, underlying drivers of inflation have hardly disappeared. Services prices remain sticky, with only modest disinflation so far, and housing has contributed a roughly 40% increase to shelter costs since 2019, keeping a firm floor under headline inflation. Wage growth is still running about half a percentage point above pre-pandemic norms, limiting how far central banks can cut without risking another inflation flare-up, even as some leading indicators show labor market softening. Tariffs add another layer to the story. They are expected to remain a fixture of U.S. trade policy and are likely to keep pushing core goods prices higher through at least 2026 as companies work through older inventory and reset supply chains. At the same time, AI-related data center demand is feeding into sharply higher electricity prices in some regions and contributing to a double-digit rise in residential power bills nationwide, while heating costs and health insurance premiums are also climbing. These dynamics risk re-intensifying inflation, just as central banks pivot toward easing. If that happens, markets pricing in modest and orderly rate cuts could be disappointed, reinforcing this as a key downside driver for risk assets. Elevated valuations, concentration, and term premia represent another important constraint on risk sentiment. Equity leadership remains heavily skewed toward a narrow group of large technology and communication services companies, with these sectors now accounting for nearly half of the main U.S. benchmark. Hedge fund positioning in semiconductors is described as extreme, and the AI trade more broadly looks crowded, raising the risk that even minor disappointments on growth, regulation, or monetization could trigger outsized drawdowns. There are growing signs that momentum is overshadowing fundamentals. Commentators describe a dash for lower quality names as investors chase rising charts, while strong U.S. earnings forecasts have not prevented European markets with weaker profit outlooks from outperforming, underscoring how sentiment rather than pure fundamentals has driven much of the recent move. Within private markets, a sharp valuation gap has opened up between a thin layer of top-tier assets and the broader universe, with many 2021 and 2022 acquisitions unlikely to achieve their original price expectations, complicating exits and capital recycling. On the rate side, persistent long-end U.S. Treasury yields and higher term premia are also problematic for valuations. Even as investors anticipate Fed cuts, the back end of the curve has not fully followed, eroding the hedging role of government bonds and increasing the discount rate applied to future cash flows in both equities and credit. With high-yield bonds near their highs and spreads still tight, there is limited compensation for the added risk if growth slows or inflation surprises on the upside. In this environment, rich valuations and concentration make markets more vulnerable to negative surprises, reinforcing the case for a cautious interpretation of today's risk-on price action. Finally, labor softness and emerging credit stress round out the bearish side of the ledger. Headline U.S. job numbers are increasingly being challenged, with some analysts arguing that, after revisions, non-farm payroll growth may be close to zero. Job gains are heavily concentrated in healthcare and other narrow sectors, while unemployment among recent college graduates has climbed to record levels relative to the overall rate, signaling pockets of weakness that aggregate data can obscure. Companies across multiple industries report slowing hiring and rising layoffs, often citing productivity gains from technology and AI as reasons to do more with less labor. At the same time, households face mounting affordability pressures from rising energy bills, health insurance premiums, and the potential expiration of Enhanced Affordable Care Act subsidies that have kept out-of-pocket costs in check. This combination of a softer labor market and higher essential expenses poses a risk to consumer spending, which has been a key pillar of growth resilience to date. Looking ahead, credit markets could amplify these pressures. Concerns are mounting that private credit has grown too quickly, with expectations that delinquencies will rise into 2026 as borrowers refinance at higher rates and weaker business models are exposed. There is particular unease about the potential for defaults or even fraud in opaque segments of private lending, with knock-on effects for banks that have material exposure. While large, Diversified banks with conservative growth strategies are seen as better placed to navigate a default cycle. The broader system may still confront wider spreads and higher funding costs. For investors, this slow-burn risk means that today's benign credit spreads and solid headline labor metrics should not be taken at face value. The underlying direction of travel is toward more fragility, not less. To sum up, today's risk sentiment is cautiously risk-on. Softer inflation prints, growing expectations of eventual central bank easing, and powerful AI-driven earnings and capex are supporting equities, credit, and deal activity. Set against that are persistent worries about sticky and possibly underreported inflation, stretched valuations and concentration, and a slow buildup of labor and credit stresses that could challenge the durability of this rally. Key signposts from here will be upcoming inflation and wage data, long-end yield behavior, evidence of follow-through in AI monetization, and any early cracks in private credit or consumer spending. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.